You never wavered, Greg, in your belief that we were going to give all this back, that we were going to go back to the June lows. And you must feel more conviction today that we're going to do that.
I am still unwavering. And one of the things that my good friend Adam Parker does is he thinks that everything that's in that big brain of his is synonymous and kind of common knowledge throughout the street, and it is probably not. But I'm going to add a couple of things to what he said, because I largely agree with him that the CPI is not coming down, that there's structural elements there, that while we're celebrating a 50 basis point decline in a month, is likely, it's not that the 50 basis point decline is something to celebrate. What we should be worried about is that this level and this persistency of inflation, by all accounts, are going to persist from the data that we're seeing. And so what that means is that we haven't seen peak Fed hawkishness at this point. They have spent the last 3 weeks walking back everything Powell said in that conference that gave the green light to go out and put risk on. And I think they'll continue to do that through Jackson Hole. I do think it matters. That's where I probably depart from my friend Adam. I think it matters a great deal, because I think when you look at the futures, the Fed futures rates, it was discounting about a 50 basis point hike in September, and I think it'll be larger than that, hopefully the 100 that I expected last go around. And I don't think the market's prepared for any of that. And so I think, remember, Scott, what I laid out in this head fake bull run, based on some false premises, is that first the market would digest that we're not past peak Fed hawkishness, and then secondly the market would digest something that Adam also intimated, which is that the back half slowdown is probably going to be deeper and of longer duration than we originally anticipated in January, when some of us said we'll likely see a recession this year.
Cameron, is that what this is? As Greg just said, is this all just that one big head fake from the June lows?
Well, we think the rally was at first supported by the macro. We saw big turns in macro drivers, things like yields starting to move lower, the dollar moving lower, energy prices moving lower. But since August, we really haven't had that macro support. They've all moved in the opposite direction, meaning that as equities kept powering higher, yields and the bond market and energy markets were really telling a very different story. We saw the bets that the Fed would cut rates in early 2023 get walked back completely, given the Fed commentary saying that this is not a pivot, we don't intend to cut rates, which meant that this equity market was at risk because it was expensive. It was trading at 19 times earnings, and that's far more consistent with a Fed that would be easing policy, cutting rates, versus a Fed that still is clearly tightening.
Do you want to respond to any of that?
I was just dividing here. I think we're probably at 19 times the real number. I mean, if the street's at 243, I largely agree with what everyone said. I mean, we're at 41.38. If there's 215 in
you got
earnings,
your trusty calculator out.
Yeah, I mean, I think we're around 19 times the real number. So, I'm not saying I don't know about the June lows. I don't know if we're headed that low, but I could see us.
I don't think Greg agrees, though, with you that 19 times is the right number. Greg, is that what you think that the valuation of the market should be?
No,
that we could trade at 19?
What it is now.
Well, I know what it might be now, but what do you ultimately think it should be? AP.
Yeah, I mean, look,
that's what matters.
I think we should trade it.
Hang on one second,
16,
Greg. Sorry.
16, 17
17. Is that what you think as well, Greg? 16,
that's what I was going to say.
times?
Look, in a high growth market, it should be 19 times, but the median is around 17 times. And so, if we're not in a high growth market, I don't see any reason to use anything outside of the median number.
What if everybody is just too negative on inflation? I'm looking at a note that passed a little while ago from Marko Kolanovic over at JP Morgan. Quote, "We maintain that inflation will resolve on its own as distortions fade, likely drive a Fed pivot." Why, Greg, is that view so out there?
I really can't answer that, to be honest with you. Three things happened at once, though. I think that view that we were in a Fed pivot, probably highly supported by what Jerome Powell said. And my belief is that he probably misspoke and probably got a call from James Bullard as soon as he got off the podium. But that was combined with what Adam said earlier, earnings coming in a bit better than expected, even though they were off of a drastically reduced baseline, as analysts had revised down about 3%. And I think that was also combined, that green light, that pivot, with this talk of this strong labor market and a strong consumer balance sheet. Both conversations we can get into, whether those are as strong as we thought, and if there's going to be any duration, if there's going to be any resiliency in the back half with those issues. So I think all those things kind of combine together to suggest, well, we have a great labor market and we have strong consumer spending, and with the Fed putting all these measures in, we see 50 basis point decline. Maybe we're here for a pivot. And, look, we saw it go down from April to May of this year as well. It doesn't mean that we had reached peak inflation.